Welcome to Introduction to Business. We're going to be looking at Chapter 4 today, Options for Organizing a Business. The learning objectives include describe the advantages and disadvantages of the sole proprietorship form of organization, describe the two types of business partnership and their advantages and disadvantages, describe the corporate form of organization and its advantages and disadvantages, and assess the advantages and disadvantages of mergers, acquisitions, and leveraged buyouts. There are three principal forms of organizing a business, whether it is a traditional brick-and-mortar organization or a virtual corporation that does business exclusively through the internet. The three primary forms of business that we will examine are sole proprietorship, partnership, and corporation. Proprietorship far outnumber corporations, but they net far fewer sales and less income. Partnerships are the least used form of business, and corporations account for the majority of the U.S. sales and income, but represent a relatively small number of organizations in the United States. Sole proprietorships are businesses that are owned by one person. The most common form of business organizations in the United States, and they typically are small businesses employing fewer than 50 people. Some advantages of sole proprietorship. They have the advantage of simple management structure and the ability to make quick decisions. They have the ease and cost of formation. Forming a proprietorship is easy and inexpensive, requiring only state and local licenses and permits where applicable. An entrepreneur starting a new sole proprietorship must find a suitable site from which to operate the business. Many small businesses started out in their founders' garages. Sole proprietorships have the advantage of secrecy as operating plans and financial reports do not have to be disclosed to others. All profits from the business belong to the owner, and the proprietor has complete control over how the business is run. This control allows the proprietor to respond quickly to competitive conditions or to changes in the economy. Sole proprietorships have the greatest degree of freedom from the government regulations. Nonetheless, proprietors must ensure that they follow all laws and do apply to their business. Profits from the business are considered personal income of the sole proprietor and are taxed at the individual tax rate. The sole proprietor can also establish tax-exempt retirement or profit-sharing account, which is exempt from current income tax. A sole proprietorship can be dissolved easily, and the only legal condition is that all loans must be paid off. Some disadvantages of sole proprietorship. The sole proprietor has unlimited liability in meeting the debts of the business. If the business cannot pay its obligations, the owner's personal non-business holdings might have to be used to pay the debt. There's a limited number of financial sources from which a sole proprietor can borrow from, such as the bank, friends, family, and the Small Business Administration. Additionally, the sole proprietor might have to pay higher interest rates on funds borrowed from banks than do large corporations because they are considered a much higher risk. The proprietor may have to pledge personal assets to guarantee a loan. The sole proprietor must be able to perform many functions and possess skills in diverse areas such as management, marketing, finance, accounting, and personnel. The life expectancy of sole proprietorship is directly related to that of the owner and his or her ability to work. It is usually difficult for a small sole proprietorship to offer the same wage benefits and advancement possibilities that are often found in large corporations. Under current tax rates, sole proprietors pay a higher marginal tax rate than do small corporations on income less than $75,000. The tax effect often determines whether the sole proprietor incorporates the business or not. A partnership is two or more people as co-owners. Most states have a model law governing partnerships based on the Uniform Partnership Act, which defines partnerships of association of two or more persons who carry as a co-owner of a business for profit. Partnerships are the least used form of organizations. Keys to a successful partnership include keeping profit sharing and ownership equal. Partner skill sets should complement each other. Honesty is crucial. Maintain face-to-face communication. Maintain transparency. Be aware of funding restrictions so one partner does not get stuck with additional debt. To be successful, you need experience, so tailor your business to your skills. Family should be a priority. Try to minimize business problems so you can enjoy your family time. Do not fall in love with the idea and forget to actually implement the idea. Be optimistic, but be realistic in terms of sales, growth, and planning. A general partnership involves partners sharing the management of a business and the liabilities for its debt. A limited partnership has at least one general partner who assumes unlimited liability and at least one limited partner whose liability is limited to the amount of investments in the business. Limited partnerships exist for risky investment projects where the chance of loss is great. Limited partners are barred from participating in management of the business, but they share the profits. A master limited partnership is limited partnership traded on security exchanges. Articles of partnership are legal documents that set forth the basic agreement between partners, usually specify the money or the assets each partner has to contribute to the partnership. This is also called partnership capital. Each partner's individual management role or duty, how the profits and losses of the partnership will be divided among the partners, and how the partner may leave the partnership, and any other restrictions that might actually apply to the agreement. Some advantages of partnerships: the ease of organization. Starting a partnership requires little more than drawing up articles of partnership. The name of the partnership should be registered with the state. Availability of capital and credit. When a business has several partners, the partnership can rely on a combination of the talent and pooled financial resources. Partnerships tend to be larger than sole proprietorships and thus have a greater earning power and a higher credit ratings. Partnerships can provide diverse skills because partners are able to specialize in their areas of expertise. Small partnerships can react quickly to changes in the business environment. And the partnership has fewer regulation controls over its activities than the public corporations. Some disadvantages of partnerships. Limited partners have no voice in management and bear most of the risk of the business. Partnerships may be subjected to disagreements when the goals and objectives of one partner change. Many partnerships disputes wind up in court. For unlimited liability in general partnerships, the general partner have a limited liability for total debts and the business occurs. This disadvantage increases one partner has greater personal financial resources. The disadvantage is reduced by limited partners who can only lose their initial investment. All partners are responsible for the business actions and decisions of all other partners. The life of the partnership is terminated upon death or withdrawal of a partner. In a very large partnership, provisions for continuation of the partnership may be provided for the articles of the partnership. Selling a partnership interest has the same effect as the death or withdrawal of the partner, and it is difficult to place a value in the partner's share of the partnership. The distribution of profits as specified in the articles of the partnership may not reflect each partner's contribution. And a limited source of funds. There's a limited source of funds or capital available to the partnership because there's no public value placed on the business. Partnerships may have to pay higher interest rates on borrowed funds than do large corporations because they may be considered a greater risk. Partnerships are quasi-taxable organizations, which means they do not pay taxes. The individual partners report their share of profits on the individual tax return and are taxed at the ordinary income tax rate for the individual. A corporation is a legal entity created by the state with assets and liabilities distinct from those of the owner of the corporation. Legally, a corporation has many of the rights, duties, and power of a person, including the right to receive, own, and transfer property. They can enter into contracts with individuals or with other legal entities, and they can sue and can be sued in courts. Corporations represent the majority of the sales and income in the United States. Corporations are typically owned by many individuals and organizations who own shares of the business called stock. Thus, corporate owners are called stockholders or shareholders. Stockholders can buy, sell, give, or receive as gifts or inherit the shares of stock. Stockholders are entitled to all profits that are left after all corporations and other obligations have been paid. These are distributed in forms of cash payments called dividends. However, some corporations may retain profit to expand the business. A corporation is created under the laws of the state in which it incorporates, a procedure sometimes called chartering. In most states, the company name must end in company, corporation, incorporated, or limited to show the owners have limited liability. The individual who creates the corporation are known as incorporators. The articles of incorporation must be completed and filled with the appropriate state office, usually the Secretary of the State. The articles of incorporation contain the basic information about the business, including the name and address of the corporation, objectives of the corporation, class of stock, and the number of shares each class of stock to be issued, expected life of the corporation, financial capital required at the time of incorporation, provisions for transferring shares of stock between the owners, provisions for regulation of internal corporate affairs, address of the business office registered with the state of incorporation, names and addresses of the initial board directors, names and addresses of the incorporators. Based on the information in the Articles of Incorporation, a corporate charter is issued by the state to create the corporation. Then the owners establish the corporate's bylaws and elect the boards of directors. A corporation doing business in the state in which it is chartered is a domestic corporation. When a corporation does business in other states, it's referred to as foreign corporation. And if a corporation does business outside the nation in which it's incorporated, it is termed an alien corporation. A private corporation is owned by only one person or a few people closely involved in its management. Private corporations do not offer stock for sale to the public. Privately owned corporations are not required to publicly disclose financial information, but they must pay taxes. A public corporation is one whose stock anyone may buy, sell, or trade. Publicly owned corporations must disclose financial information to the public under specific laws that regulate the trade of the stocks and other securities. A private corporation may go public through initial public offerings by selling its stock so that it can be traded in the public markets. Public corporations may be taken private when one or few individuals purchase all the firm's stocks so that it can no longer be traded publicly. Quasi-public corporations are corporations owned and operated by federal, state, or local governments. These provide a service to the citizens rather than earn profits, and examples of that include NASA and the United States Postal Service. Nonprofit corporations focus on providing services rather than earning a profit, but are not owned by the government entities. An example of this would be the American Lung Association or American Red Cross. Most nonprofits organizations are organized as 502c3 organizations, which receive certain tax exemptions and donors contributing to the organizations may reduce their tax deductibility for their organization. The next couple of slides are going to look at the elements of a corporation. We're going to start with the boards of directors. The boards of directors is elected by the stockholders to oversee the general operation of the corporation. The board of directors set the long-range objectives of the corporation and sees that the objectives are achieved on a schedule. The board members are legally liable for the mismanagement of the firm or for any misappropriations of the fund. One of the board's most important duties is to elect or hire the chairman of the board, the president of the company, and a chief executive officer, also known as the CEO. Directors can be from both sides, inside and outside of the company. Most boards include outside directors because they are thought to be less biased in their assessment of the company's progress. Corporations issue two types of stocks, preferred and common. Preferred stocks usually allows no voting rights but confers preference in the distribution of company profits. Owners of preferred stock are a special class of owners because although they generally do not have any say in running the company, they have a claim in profits before other stockholders do. Most preferred stock carriers a cumulative claim to dividends, which means that if the preferred stock dividends are not paid in 1 year, they accumulate to the next year. Common stock allows the owner voting rights. Owners of common stocks do not get any preferential treatment with regards to dividends, but they do get some say in the operations of the corporation by voting on board members and other important issues. Common stockholders have a preemptive right to purchase new shares of the common stock directly from the corporation. Advantages of corporations: the owner's maximum liability or potential loss is equal to their original investment. Stockholders can sell or trade shares of stock without causing the termination of the corporation. The corporation may continue its existence forever or until the owners agree to sell it or liquidate the assets. There's an external source of funds. They have long-term funds that can be raised more easily by public corporations than by partnerships or sole proprietorships. The firm can raise new funds by selling new shares or bonds to the public. They have a readily available external financing, making it easier for the business to expand into national and international markets. Some disadvantages of corporations: double taxation. The corporation pays taxes on its income, and then the stockholders also pay tax on the dividends distribution they receive from the company. The formation of the corporation can be costly and can require the services of an attorney. Financial and other proprietary information must be disclosed to the shareholders, creditors, and the Securities of Exchange Commission, which oversees the securities of deposit and corporations. Therefore, this information may be accessible to the competitors. Employee-owner separation. Non-owner employees may feel that their work benefits only the owners. Employee stock ownership plans give shares to the employees to help create more of a partnership between the company and the employees, and therefore boost productivity. A joint venture is a partnership established for a specific project or for a limited time. The partnership in a joint venture may be individuals or organizations, as in the case of the international joint ventures. Control of the joint venture may be shared equally or one partner may control the decision making. An S corporation is a form of business ownership that is taxed as though as if it was a partnership. Some advantages of an S corporation include simple taxation, limited liability of shareholders, perpetual life, and ability to shift income and appreciation to others. Disadvantages include restrictions of the number and types of shareholders and the difficulty of formation and operation. Limited liability companies is a form of business ownership that provides limited liability, but it's taxed like a partnership. A major reason for using an LLC form is to protect members' personal assets. They are flexible, simple to run, and do not require members to hold meetings, keep minutes, or make resolutions. A cooperative is, or a co-op is an organization composed of individuals or small businesses that have banded together to reap the benefits of belonging to a larger organization. The co-op is set up not to make money for itself, but to help its members make money. The most common example of a co-op is found in farming or agricultural organizations. Purchasing and distribution and advertising savings can benefit the co-op members. As companies achieve growth and improve profitability by expanding their operations, often by developing and selling new products, or by merging with or purchasing other companies. A merger occurs when two companies combine to form a new company. Horizontal merger is when a firm that makes and sells similar products merge. Vertical merger is when companies operating at a different but relative level of an industry merge. And conglomerate merger is when firms that are unrelated in industries merge. Not all mergers are pleasant, such as when Duke Energy and Progress decided to merge. It was initially cited that Progress CEO Bill Johnson would lead the newly merged company. However, shortly after the merger, the board of directors ousted Bill Johnson and reinstalled Duke CEO Jim Rogers as CEO in the move that resulted in widespread criticism. An acquisition occurs when a company purchases another, usually by buying its stock. Corporate raider is a company or individual who wants to acquire or take over another company and first offers to buy some or all of its stock at a premium tender offer. A poison pill is the firm allows stockholders to buy more shares of a stock at a lower price than current market value to head off hostile takeover. Shark repellent is management requires a large majority of stockholders to approve the takeover. And a white knight is a more acceptable firm that is willing to acquire a threatened company. A leveraged buyout is the purchase of a company by a group of investors with borrowed money, using the assets of the company to guarantee repayment of the loan. Merger mania is what's happened in the 1980s and 1990s during a prolonged wave of mergers and acquisitions. Some people view mergers and acquisitions favorably, pointing out that they boost corporations' stock prices and market value to the benefit of their stockholders. Mergers can be controversial, with critics arguing that they actually hurt the companies. Once again, I want to thank you so much for listening to this lecture. If you have any questions, please don't hesitate to reach out to me. Thank you.